If you're involved in real estate financing, you might have come across the term DSCR loans and wondered, what does it mean? This comprehensive video is your key to understanding DSCR loans and standing out as an expert in a crowded loan broker space. Hi, I'm Ian and I own Grafton Funding, one of the most respected DSCR loan brokerages in the US. And I have clients all over the country who trust me with their DSCR loans. Okay, so first, let's cover what a DSCR loan actually is. DSCR stands for Debt Service Coverage Ratio, and it's a particular type of long-term mortgage on an investment property, usually 30 years, but sometimes you do see 20 years or 40 years too. The DSCR is a formula used to calculate a property's net cash flow from rental income after accounting for its expenses, so loan repayments, taxes, insurance, and HOA fees if there is any. Different lenders will have different requirements for the minimum DSCR. So some are okay with a break-even cash flow. Some need a 10% cash flow. Some want a 20% cash flow, etc., etc. With the DSCR loan, it's not a question of whether the borrower can afford the loan. It's a question of whether the property itself can afford the loan. DSCR loans provide a method for people to purchase and refinance investment real estate without having to go down the route of a conventional mortgage. Now that you know what a DSCR loan is, how and when is it used? It can be used for purchases, rate and term refinances, and cash out refinances. Investors use DSCR loans when they can't or don't want to use a conventional mortgage for their investment property. Another use of DSCR loans is when investors want to have the ownership of the property and the loan in the name of an entity, which can give extra legal and credit protection to the borrower. So you might be wondering, why can't I just use a conventional loan for investment property instead? The main difference between DSCR loans and conventional mortgages lies in the way that the lenders underwrite the loans. Remember what I said earlier, it's a question of whether the property can afford the loan, not whether the borrower can afford the loan. Anyone that has ever purchased a home before will know that conventional mortgage applications are evaluated based on a borrower's credit history, their income, their assets, their debts, and other financial factors. While the property's value and rental income may be considered, the borrower's personal financial situation plays a much more significant role in the underwriting process. A lender will be examining the borrower's W-2s, their tax returns, their debt-to-income ratio, and their creditworthiness to determine if they can afford the loan. The evaluation of a DSCR loan is based on the property's income-generating potential. Lenders assess the cash flow generated by the property, which is determined by the DSCR, to determine the borrower's ability to repay the loan. With DSCR loans, we will never need W-2s, tax returns, personal financial statements, and all the other personal financial information that's required for a conventional mortgage. Some other important differences between conventional mortgages and DSCR loans is that a DSCR loan can be closed in the name of an entity, whereas a conventional mortgage cannot. Also, you're limited to a maximum of 10 conventional mortgages, whereas with DSCR loans, there's no limit to how many you can have. And lastly, DSCR loans are slightly more expensive than conventional mortgages in terms of interest rates, but that is the trade-off that you get for the benefits that a DSCR loan can bring. If you want to be a successful broker in the DSCR loan space, it's vital that you understand and that you can explain to your client the differences between a DSCR loan and a conventional mortgage. An educated broker leads to educated clients, which leads to a smooth loan process. So I understand math isn't everyone's strong suit. The way to calculate a DSCR is really quite simple. The total amount of the monthly loan repayment, so principal and interest, or interest only if it's an interest-only loan, as well as the property taxes, the insurance, and the HOA fees if applicable, they are all collectively referred to as debt service. You then calculate the debt service coverage ratio, so the DSCR, by dividing the monthly rental income by the monthly debt service. So let's say a property has a monthly rental income of $2,500 and it has a monthly debt service, so all the debts added together of $2,000. So that would be a DSCR of 1.25. So 2,500 divided by 2,000 equals 1.25. When the DSCR is 1.0, it means that it's a break-even cash flow. So the monthly rental income just covers the monthly debt service. Anything above 1.0, and the borrower has positive monthly cash flow. And anything below 1.0 means that the rental income is not covering the monthly debt service. So the property is underwater. As a broker, you will work with different lenders that have different requirements for that minimum DSCR. So a 1.0 or a 1.1 or a 1.2. Some lenders will actually be okay with a DSCR of 0.75, for example. So they will actually approve the loan even if the property is losing money every month. So now that you know how the DSCR is calculated, you can advise your clients on what they need to do to get their loan approved. So maybe they need to increase the monthly rent. Maybe they need to do an interest-only loan so the monthly payment isn't so high. Maybe they need to shop around for their property insurance as the premium they have right now is so high that it's throwing off the DSCR. By understanding these factors, brokers can tailor their services, they can increase the likelihood of getting their loans approved, and they can build lasting relationships with their clients. Understanding DSCR loans and how they work empowers borrowers and investors with valuable insight into rental income potential and securing their real estate finance. And it is up to you as their broker to help them understand how DSCR loans work. I train brokers in the investment real estate financing space and show them how to be successful. If you're interested in learning more, check out the link in the description. Subscribe, and I'll see you in the next video.